Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. 3 weeks ago, I said that there were three major patterns here in this market in recent times. There were a possible bearish halfway hesitation, a mid-February to mid-April bearish Andrews pitchfork, and a mid-November 2021 today head and shoulder top with a neckline currently at 198.70, acting as a backup support. So what could we then expect next? I said at the time, and I quote, "Well, it very much depends if prices can drop down through the November 2014 high at 201.35, because then we can look at additional possibilities on the downside, and not just target X below the top," and that's the end of the quote. The top side at the time was capped by the flat long moving average, currently 220.30, plus the 50% Fibonacci line of the August 21 to February 22 move at 217.45. I added as a final note, and I quote again, that should prices punch up and maintain levels over these, then the bearish halfway hesitation as well as the head and shoulders top and even the bearish Andrews pitchfork will all cease to be the primary drivers of this market, and something else will have to take its place, end of quote. Well, something else started 3 Wednesdays ago. A large bullish opening long white Mariposa that closed up over both the 50% Fibonacci line at 217.45 and also the long moving average. Yet this move up was tempered as prices subsided back below the 50% Fibonacci line and the long moving average, but continued to harry and pressure the acute bearish Andrews pitchfork. Enough that I retired it and instead started using the more shallowly bearish shift pitchfork. Even this was not secure, as 2 Tuesdays ago prices pushed up not only through the long moving average and the short medium moving average, currently 221.15, but also the upper time, currently 219.80, of the new shallowly bearish shift pitchfork. At the time it was only the congestion at 227.60, 228.40 and 229.15 plus the overhead slowly descending medium moving average, currently 229.30, that managed to contain the rise. Yet the upper time was breached. But with only one closer of it, it was not yet broken. Then last Wednesday, the market made a further attempt higher, starting with a bullish engulfing pattern leading to a huge bullish long white Mariposa that shot up and closed over all the moving averages, bar the medium moving average. This move up has pronounced a death knell for the bearish shift pitchfork and the possible bearish halfway hesitation. Plus, it may well have converted a head and shoulders top pattern to a head and shoulders continuation pattern. Last Friday, prices went further, pushing up and closing over the medium moving average into a fairly free area that stretches up to at least the April high at 237.70 and maybe as high as the 2012 high at 241.05. It also made last week a weekly key reversal up. What is needed now is further confirmatory moves this coming week. In the meantime, I'll retire the bearish shift pitchfork and the idea of a possible bearish halfway hesitation, and start thinking about the possible topside opportunities for a continuation head and shoulders pattern. London coffee. The key difference seen here in London compared to the New York contract is how the peak of the market was back in late December 21 rather than when New York had it in early February 22. This difference has been crucial to the early formation of a pattern here in the London contract much earlier compared to the New York contract. We have a November 21 to February 22 head and shoulders top. Admittedly, the first shoulder is split, but the action nevertheless stacks up as a legitimate pattern. The neckline is currently at 21.18, and the market, which had broken through it back in March, ended up having some difficulty since then in penetrating the support area below that stretches from 20.04 level all the way down to the secondary target X in the 1935 area. 3 weeks ago, prices had a further attempt lower, making a new low not seen since August 21. Yet that achievement should be taken with a pinch of salt, as it was only a little lower compared to the low in early March. Nevertheless, it is worth noting that the primary target for this head and shoulders top had been achieved some while ago, and it was a secondary target that was still left. As I've often pointed out, secondary targets are harder to achieve. 2 weeks ago, the market started to develop intraday indecision with contrary patterns, one after another. This indecision seems to have worked itself out as prices have broken up through the broken very late December downtrend, currently at 2057, plus the upper time, currently 2062 of the newly drawn mid-February to early May bearish Andrews pitchfork. Late last week, they have tackled the sidelining medium moving average, currently 2100, breaking it but not clearly pushing up over it. Just above now we have the upper time, currently 2121 of the bearish shift pitchfork for the same move as the bearish Andrews. Then there's a neckline of the head and shoulders top pattern, plus the declining short medium moving average, currently 2144, and the rising long moving average, currently 2160. All these are now under threat, as we seem to have built up a significant support and ammunition zone that stretches from roughly where we are all the way down to just short of 2000. And we have the possibility now of a March to date double bottom as well, or at least a possible rectangle pattern. After this commentary, the bearish Andrews pitchfork targets X and X1 will be retired and the downtrend reassigned. I look forward to seeing what the next week brings. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.